Hi, I'm John Pasalis, housing analyst and founding broker at Realosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto Area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview.
Hi, I'm Remy Desai, Head of Content at Realosophy and editor of movesmartly.com. My next conversation takes place right here at Realosophy HQ, home of the summit. I'm talking to my partner, John Pasalis, who heads up Realosophy's sales team and is a housing analyst and researcher. John's research into housing price bubbles and home prices was cited by the Bank of Canada in 2017. I'm interested to learn from John how we can use these insights and these top-level research insights into actually making better decisions as home buyers and home sellers. Hi, John.
Hi, Irene.
Not sure I would want to be somebody that's trying to track the real estate market right now with data or without. It's been absolutely crazy. But let's look at how you do use data to look at the market. And let's take ourselves back to December, January, the beginning of this year, that land far away.
Yeah.
What was the data saying about the market then?
So the market was really accelerating towards the end of 2019, leading into 2020. And we had a really slow couple of years in 2018 and 2019. And then as we got into around November, December, January, the market was on fire. Like it felt like the speculative mood of 3 years ago, or plus years ago, 2016, 2017. It was just so competitive, very aggressive kind of bidding wars, lots of people, and a very heated market. I mean, I think in the first couple of months, prices were going up something like 16, 17%, which is very high. So it was a very hot market, kind of ending 2019 and heading into 2020.
Now, did that continue right until mid-March when the market suddenly has to shut down overnight?
Yeah, it did actually. I mean, the market was hot right up until mid-March. And even, I'd say, the first kind of week or two after the state of emergency was still pretty busy. It was kind of right around April where just things fell off a cliff and buyers really hit pause and the bidding wars slowed down pretty quickly.
So take yourself back to your mindset. What did you think when you realized that's it, transactions can't happen, people can't show homes, we all need to stay at home?
Yeah.
What were your initial thoughts about what this meant for the market?
Not positive. I mean, it's actually interesting because it's so hard to obviously predict what's going to happen. But I think myself and a lot of the people I talked to were not optimistic about the rest of the year, at least up until August. I think most people, even in my industry, were thinking it's going to be a sluggish spring and summer. As people hit pause, there was obviously a lot of uncertainty about the virus, about the economy, job losses. And I think most people's best guess what things were going to pick up in September. So I don't think everyone was overly pessimistic, but they're definitely pessimistic for the short term. At least to the summer for sure.
Now, did COVID itself, though, because that market was so unpredictable, also unforeseeable in a sense, did it change how you were looking at the data?
To some extent. I mean, it was like the trends that we were seeing were kind of like unprecedented. I mean, we saw sales collapse by something like 75% over last year. We saw listings collapse almost like the same amount. So it was literally like someone had hit the brakes on the market, right? And it didn't change the way we looked at data in the sense that we're still trying to understand the balance between supply and demand, because that's an important sort of variable that really dictates what happens to prices. You know, if the sellers had kept selling when buyers pulled back, it would have been a lot of pressure on prices to go down. But one of the reasons prices were relatively stable is because sellers pulled back as well and listings declined. So in that sense, we did look at some of the same metrics to get a better sense for how balanced the market is.
And blogging for us at movesmartly.com, I note that you moved to reporting on the numbers weekly.
Yeah.
Is that something you're normally comfortable doing? And why did you think you had to do that with the COVID crisis? And why have you stopped doing it now that it's
so the housing market normally doesn't change fast enough for you to need to look at data weekly. It just is generally like not much changes from the first week of the month to the last week of the month, right? But when we have these big shocks to the market, things rapidly change from week 1 to week 4 in the given month. So that's when you need to do a weekly analysis to see just how things are progressing, because the monthly data doesn't really tell you which way things are going. So for example, if the monthly data may say, you know, sales are only down 15%, but it masks the fact that for the first 2 weeks, sales were up significantly, and the last 2 weeks they plummeted, right? So weekly data or weekly analysis allows you to sort of track sort of these important trends. And as you noted, I stopped doing it because as the market kind of stabilizes, you don't really need to look at it that obsessively. I mean, I personally do still look at it to understand if there are any big changes. I don't always report on it because it's, you know, it's a bit too much information. It probably doesn't say that much.
The editor
Yes.
in me said it's not always a news story.
100%.
So that makes sense. Now, in lockdown at the height of it, about April, May, CMHC comes out with a market report, that's the Canada Mortgage and Housing Corporation, with an outlook for Canadian real estate following COVID.
Yeah.
And their prediction was for up to an 18% fall in home prices, with the recovery taking as long as 2-3 years out to 2023. Now, when that report comes out, many people call it too pessimistic.
Yeah.
And you wrote about not being quick to call it too pessimistic and why that was important.
Yeah. You know, I'm not, you know, I think it's important to, especially in uncertain times, to look at everyone's analysis. I mean, the reality is no one has a crystal ball. You know, CMHC does have data that a lot of other organizations don't have. And, you know, they have information on their clients and they can track how their credit scores are changing. So maybe they have information that other people don't. So, you know, I'm not quick to dismiss CMHC or anyone's pessimistic view. I mean, I think it's important to think about what these potential worst cases are to mitigate them. You know, but I think with all forecasts, they evolve. And I think, you know, everyone needs to revisit their assumptions as kind of data changes.
So CMHC forecast you would call more of a worst case scenario?
I mean, I think it's hard to say what the worst case scenario is, but it's certainly among the more pessimistic forecasts that I've seen. Most people are not expecting housing prices to crash to the extent that CMHC is. I mean, CMHC is very, very bearish. You know, I mean, if you read the reports, it's almost like they write as if it's a fact that, you know, they write about prices will fall, not prices may fall. So they've just convinced themselves that their narrative is correct. And I don't know if it is, it seems to certainly be the most pessimistic one.
Now, a month later after that report comes out, here we are in a glorious summer in Norway's and when we're allowed to see more people, albeit at a distance and outside, and buyers rush back to the market. Yeah. And I would say this is surprising. Were you surprised?
I was totally shocked. I mean, I think most people were surprised in my industry. I mean, I think, like I said, a lot of people who I talked to in the real estate industry were expecting, no one is expecting the market to tank this summer. Everyone is expecting a very calm but slow market. but no one really that I know of was expecting the market just kind of returned to where it was 3 months earlier. You know, it's like it hit pause for 2 months and then everyone just rushed back in. And certainly I don't think, and I can't think of too many people who thought the market was going to respond in that way that quickly following the shutdown.
Did you find yourself being too pessimistic at times?
Oh, 100%. I mean, you know, I think I'm often more more often pessimistic, you know, in my own nature because I'm worried about the worst case scenarios. So, you know, I often contemplate those more. But yeah, I certainly, I wasn't necessarily pessimistic, like I said, in the sense that I thought the market was going to tank, but I was not optimistic about the fall or the summer and spring markets. Like I said, we thought it was going to be very slow sales, very slow for listings, and, you know, perhaps return in September.
Now, the key, I think, to this whole thing about prices having remained stable, even though we saw this tremendous drop off of volume, as you were saying, almost 70% reduction, has been that new homes have not come onto the market as fast. So sellers haven't come back in as big a number. So when buyers stayed at home, sellers also stayed back. Exactly. And so with those supply and demand staying together, prices held. Mm-hmm. Now, looking to the fall, is your outlook still that will be the case, or is there some concern, and maybe this is what CMHC and others are worried about, that sellers for some reason will need to enter the market in great numbers?
Mm-hmm. Yeah, I think that is, you know, if you read CMHC's forecast report, they do talk about this concern about a deferral risk or a deferral cliff, and that is all of the people who are deferring their mortgages, you know, 15+% of households with mortgages. What happens when those deferrals run out? Will they need to sell their home in the fall? And certainly, you know, I've talked about how these are concerns for the outlook going into the fall, you know, especially as some of the stimulus ends. I'm not quite as pessimistic, I mean, for a number of reasons. I mean, number one, looking at how the market has responded, I mean, you need to sort of factor that into your math. So, and what I mean by that is, clearly this slowdown has not had a significant impact on demand, right? So demand, at least in the short term, is still there. A lot of the jobs that were lost were not, you know, probably disproportionately impacted renters more so than home buyers. I don't expect a really big spike in people selling their home because they can't finance them, for the one main reason that a lot of households in the Greater Toronto area have equity in their homes, right? So when you think about you know, people who needs to rush to sell, you know, why are they rushing to sell, right? And a lot of the times it's because they've lost their job and they don't have income to support their payments. So that is, you know, what we call, like, it's a liquidity problem. They just don't have, they have more kind of expenses going out. They don't have money coming in. They're illiquid, but they're not insolvent, meaning their home is still worth something, which means in a worst case scenario, you know, you potentially take some money to your house, even if it's at a private lender at a higher rate, and you take your time to sell your home. You're not necessarily just going to dump and sell your home on the market at any price because you're distressed. That's my instinct. I don't think we're going to have a lot of that distressed selling happening that I think a lot of the, I think, overly bearish people are expecting, and some of them maybe are even hoping that to happen. I don't see that happening in any big numbers this fall.
So your outlook for fall generally then is?
I think it's still going to be busy. I mean, I think, you know, I don't know if it's going to be quite as busy as it is now and as competitive, but I think it's still going to be, we're going to have a market of rising prices. I don't think prices are going to tank the way CMHC thinks they will. You know, but again, all of this, of course, just depends on how our economy responds. Is there a second wave? You know, all of these types of things. I mean, of course, if there's a big second wave and we have to shut things down again, I mean, all bets are off. Nobody really knows. If we somewhat contain it and the economy gradually starts opening, again, I think it's going to be relatively busy. I think there's still obviously downside risks of potential more job losses. But again, I don't think those are going to be big enough to just cause prices to fall in the short term.
And it's worth noting that CMHC also released another report. It reiterated that its analysis is Canada-wide, and that it does expect some cities, Toronto and Vancouver amongst them, to recover faster, even in their analysis, because of the nature of the work that takes place in those cities, not being as on-site dependent.
Yeah, and I think a lot of people who are looking at the housing market are expecting Toronto and Vancouver to kind of weather this storm a little bit better, and I probably tend to agree with that. Yeah.
So turning to the art and science of data analysis, more generally, you often talk about a metric that you really love. You've touched upon it, the months of inventory metric. I'm wondering if you can explain what that is and why you think it's a better metric to look at than average home prices, for example, and volume of sales or number of sales.
Yeah, so the months of inventory, I mean, it's a pretty simple metric. What it does is it looks at all the homes that are on the market in a given month. So just say there's 1,000 homes for sale. And then it says, okay, how many homes sold in that given month? And if 500 homes sold in that given month, we basically take the number of homes divided by the sales. So 1,000 divided by 500, we have 2 months of inventory. It basically means if no more homes came on the market, it would take roughly 2 months for those 1,000 homes to sell, given we're selling about 500 a month. I find it's an important metric because it kind of, it shows you the balance between supply and demand at any given point in time. So it actually kind of captures this balance between the two. It's not just looking at sales, it's not just looking at listings, it's actually looking at the relationship. So number one, at any given point in time, you can see how balanced the market is. So the higher the months of inventory, the more sluggish the market is. If we have 6 months of inventory, it's a very slow market. If we have 1 month of inventory, which is kind of what we have now in a lot of areas, it's a very fast market, lots of bidding wars. So it kind of tells you sort of where the market is today, but also when you sort of track the changes, it tells you what the momentum of the market is. And what I mean by that is that, in May, we went from a market that had 3 months of inventory plus. And when you track the data every week, the months of inventory was kind of going down like this, right? And when you're tracking it weekly and monthly and you see sort of the trend going down, it tells you that the market is heating up, right? And it's kind of an indication into where things are going. And then similarly, when all of a sudden months of inventory starts to tick up again, it's telling you that we're moving towards a market that's actually cooling down, right? So I find for those reasons it's an important metric. I mean, it's obviously not perfect, but it's certainly a good metric in sort of understanding the balance of the market right now and where things are heading in the future.
You often write about it being more like a speedometer. So it tells you how fast things are happening, where an average price every month may not really tell you much of that story.
Yeah, exactly. Because average prices actually are a function of sort of months of inventory. Again, the more competitive the market is, the higher the price growth. The more sluggish, the more months of inventory, the lower the price growth. So certainly it is like a speedometer in the sense that it kind of tells you how quickly prices should be rising.
So when we talk about a crisis like COVID, are the regular metrics like month of inventory as important? We've been hearing from others that I've been talking to a challenge, because a lot of the data points that are normally relied on to produce data points for June, July, to make predictions into the future, are reporting what people are calling useless information. They're telling us about the COVID situation, in which the speedometer kind of just died. So is that a useful metric in times like this?
So months of inventory is not a metric you use to forecast, okay? Meaning it doesn't necessarily tell us where we will be 6 or 9 or 12 months from now. It's kind of a metric you use if you want to do nowcasting, which is basically where are we now and where are we heading in the short term, okay? So that's really kind of the main way to use that metric. And even that is very important if you're looking and working with people day to day who are trying to make important decisions. When it comes to forecasting, you're right, that is not necessarily the best metric to forecast. I personally don't do a lot of forecasting because I've just come to terms with the fact that it's very, very hard to get forecasts right. They're often based on a lot of assumptions, and it's very hard to accurately predict where things will be 6 or 9 or 12 months from now. And if you look at all the forecasts from the banks to CMHCs, they range from, I think TD is expecting house prices to end the year up 8%, and of course CMHC expecting house prices to fall by as much as 18. So that's a huge difference, right?
Yes, and all produced by great economists.
Yes.
So now in your academic work, however, you are trying to do just that, or at least analyze housing bubbles. I guess I'm curious about whether you're trying to forecast housing bubbles, but first, what does a housing bubble mean to you?
So a housing bubble is really a period in time where the growth in house prices is not driven by what we call fundamental factors. It's driven by the sort of irrational exuberance and excitement about housing where people just buy in, not caring about if it's a good investment decision because they just assume prices will keep going up forever, right? Now, there are kind of sort of two key things when looking at a bubble. I mean, number one is you have to have a lot of these are rational buyers. And a lot of times they're investors who are just investing in real estate and not really caring about they're just rushing in and buying real estate. So you have that sort of this irrational exuberance. And then, but you also have to have a market where house prices are disconnected from their fundamentals, right? If house prices make sense to the fundamentals, then you don't really have a bubble. Like it's just a balanced market. You might have a lot of investors, but it's not necessarily a bubble. So it's the combination of both elevated house prices and strong demand from investors who are not caring about the return on their investment, because especially the cash flow on their investment, because they just think prices will keep going up 10 to 15% a year.
So when you say prices that are strongly linked to the fundamentals, are you referring to certain parts of the economy, job growth is good, economic growth is good, or are you referring to something else when you say fundamentals?
So when economists study if house prices sort of make sense, there's kind of two main ways they do it. So one is they sort of look at house prices relative to incomes and try to understand if incomes can explain the price growth. The other method, and the method that I typically use for my research, is sort of comparing house prices to rents. And it's this idea that you should only be paying so much more than it would cost you to rent that, because if you're paying 80 times what it would cost you to rent it, well, why don't you just rent it? It's significantly cheaper. So there's definitely this relationship between rents and house prices that should be somewhat linked. And when those sort of disconnect, especially when you're an investor, because when you're an investor, you actually, you don't have, like a home owner may pay a little bit more for a home because you're going to live in it, it's their kid's backyard and all of these things. If you're an investor, in theory, one of the key things that you should be looking for is the rents that you're going to earn on that property, right? And that's one of the important considerations we look at to understand if things don't actually make sense anymore and if they start looking irrational.
And has it been hard so far to model bubbles academically in the research?
Yeah, I mean, certainly. I mean, it's been quite hard for academics to model. So there's a lot of research, of course, in modeling whether home prices are disconnected from fundamentals. Most of it focuses on incomes. It's hard for them to use rents because there aren't a lot of great data sets for rents, right? A lot of times what economists will do is compare home prices to average rents or median rents, but the rents they'll use are like rents provided by CMHC, but those are purpose-built rentals. So it's like comparing apples to oranges. A 2-bedroom apartment in a 60-year-old building is not a substitute for a single-family home with a backyard, right? So one of the challenges is that data is not always available when you're trying to compare apples to apples. So that's sort of the challenges with figuring out whether things are disconnected. The other challenge, of course, is on the sort of this rationality side. Most of the people who have done research, economists like Robert Shiller and Carl Case, they often do surveys to understand sort of the mood. It's like this branch of sort of economics called behavioral economics, where they try to understand people's motivations, what they're thinking, the rationale. And the challenge with surveys, of course, is, you often do them and you get the results significantly after you may be in a bubble. So I mean, it's helpful sort of looking back, but it's not really helpful for today.
So this idea of bubbles and looking at them approaching, hopefully avoiding them, avoiding a burst, part of the burst. It seems to me that there's two groups of people that should be concerned about a bubble, that are most vulnerable. Leaving aside whether a housing collapse kicks off a larger economic downturn, which would affect everybody. It seems the two groups that really should be concerned are, one, anybody actively buying and selling in an area where there are some concerns that there could be bubble conditions percolating and maybe leading to a collapse. Now, the second group is homeowners who aren't necessarily looking to buy and sell, but kind of the same way we look at our SPs, are a little bit alarmed when they see their on-paper value of their homes potentially going down by 18%, for example, or how much percent. So I see these two groups as very distinct, and I'm wondering if you could take us through maybe three bubbles: the 2008 US bubble, the 2016 Toronto bubble, and the 2017, I'll say, York Region bubble, so just an area north of Toronto. What types of groups of people were affected by that really, bubbling, overheating of the market, and then the subsequent collapse?
So the 2008 financial, so it was quite different what happened in the US than what happened up here. Down there, it was largely driven by subprime lending, very easy access to money, often lending to people who had lower incomes and probably shouldn't be getting the mortgages they were getting. So it actually had a really, really negative impact on kind of the people who were making the least money in the US. So it's a terrible result and economic recession that kind of followed. So, and of course, in some areas, it obviously didn't just impact those people. You had a lot of just investors in areas like Phoenix and Las Vegas and in Miami just buying tons of real estate. So, those people, a lot of those cities were significantly impacted when house prices collapsed, because many of them, house prices, I mean, in some cities still haven't recovered from the rapid acceleration and then the subsequent decline in 2008.
So that would affect even the average homeowner.
Yeah, well,
in that situation.
Yes and no. I mean, it depends on when you bought, right? So if you bought well before that rise, I mean, yeah, you technically on paper saw your house go way up and go back way down, but it probably should never have gone as high as it did to begin with. So, your house today is probably what it should be worth, right? But certainly the people who bought near the peak and kind of weren't following the market closely certainly were impacted. And many of those people ended up losing their homes in the US. So in the GTA, I mean, we had a really rapid acceleration in 2016. It started in 2015, actually, 2016 and 2017. That was largely driven by investors who wanted to buy single family homes just to rent them out. And again, this is kind of what started me into more actively researching housing markets. It was actually this kind of phenomenon when people just walk into our office and saying, I want to buy a home in York Region for 1.2 million. And when I'd say, okay, but you're only going to rent it for $2,500, which is a terrible return. Like you just lose money on the investment every month. You're just bleeding cash. And most people's reaction was, I don't care, because it's going up 10% a year. Every year I'm making 120 grand, so who cares? And this kind of goes back to sort of the irrationality that I'm talking about. It's not rational to spend 1.2 million on a house that's only grossing you $2,500 a month. So that doesn't even account for your taxes, your interest, your maintenance, any of that stuff. So, and this is really kind of where I started. One of the things I started doing is sort of looking at the different segments of the housing market, because a lot of sort of academic research that looks at sort of the disconnect between house prices and rents looks at the entire metropolitan area. And what I wanted to start doing is sort of looking at them separately, because my theory was things can disconnect differently at different rates across different segments of the market, even within the same city. And that's exactly what happened. So York Region happened to be sort of this epicenter where all of these investors were flocking, buying these homes. Price to rent ratios were insane. and then it started trickling to other segments of the market. And by 2017, the first quarter, house prices were going up 30% year over year. I mean, it's completely irrational. You know, and then it just stopped. And it stopped because the provincial government put in the foreign buyers tax. And a lot of people, you know, say they blame the government for putting in the foreign buyers tax. The foreign buyers tax did not cause the crash because there weren't that many foreign buyers to justify that level of purchasing by investors. The foreign buyers tax was like a slap in the face to the market that basically said this is insane, and it just kind of woke everybody up. And when that happened, house prices crashed very quickly. I mean, close to around 20%, literally in the span of 4 or 5 months, and predominantly in New York region.
So there, obviously, the average homeowner would have just seen a blip go up and down on paper.
Yeah.
Who would be hit in that kind of situation?
So the people that were hit the most in that period were people who bought homes in the first quarter of 2017. So you bought a home in March, very excited. You go to sell your home, and then all of a sudden, in the span of a month and a half, the market falls out from under you. Okay. So for example, you own, you just paid $1.5 million on a home. Your current home is worth roughly $1 million. You try to sell it, it's not selling. And by the way, every month that passes that you're not selling it, the home you bought is declining in value and your current home is declining in value. So what happened for a lot of those buyers, they bought in March. By the time June hit, when they're supposed to take possession of their home, you know, the $1.5 million home they bought was only worth, say, 1.25, so it's dropped in value by 250 grand. And their current home, which was worth $1 million, is now only worth 800,000. So they've lost money on both transactions. And in many, like you saw the news articles, in many cases, if they couldn't sell their home, they just defaulted on their purchase. They got sued by the seller for the loss in value. So it was a terrible result for a lot of people who were in the market at that time.
And some are saying that we are in bubble-like conditions here in the Toronto area.
Mm-hmm.
This is pre-COVID.
Yeah.
Some are saying it'll accelerate, precipitate a crisis or not. What do you feel about that, about claims of us being in bubble conditions right now?
You know, I think again, even though I researched this up, it's hard to put like a specific time frame on, yes, now it's a bubble and now it's not, right? Certainly home prices, I think a lot of people are kind of missing an important point. There's a difference between home prices being elevated and there's a difference between a bubble, okay? So for example, I spoke with, so one of the economists I spoke with, interesting enough, was with Josh Gordon from Simon Fraser University, and he had research on why in many areas, for example, in York region, a lot of the households are what we call satellite families. So the families there, the main income earners, say that one of the parents earns most of their income outside of Canada, right? But the family lives sort of in York region. So they pay their taxes in a foreign country, which means on paper here, they have very modest income. So that's why if you actually look at the price to income ratio in areas like Markham and Richmond Hill, homes are like 12 times household income, say, right? Whereas, in the GTA as a whole, it's something like 8. So does that mean that York and Markham are just all of this irrational, crazy buyers? Or is it the rational explanation is, well, incomes are being underreported for these purposes because a lot of the households don't earn their income in Canada. So I think it's important to kind of understand that there could be rational reasons for house prices to be elevated. Of course, record low interest rates is yet another one. And there's a difference between a bubble, right? And certainly when you start seeing house prices appreciating at 16 and 17 and 18%, those are like bubble type appreciations. When home prices are going up 2 or 3%, that's not typically, red flags of kind of bubble territory. But certainly at the beginning of the year, I think a lot of people were worried that we're getting into that segment where fear of missing out and investors jumping in was fueling house prices.
So it's the two parts. First, you're seeing the fundamentals perhaps start to stray from home prices.
Yep.
And then you're looking for that irrational exuberance that you're
Exactly.
talking about. So you're kind of looking for those two conditions to be present.
Absolutely.
It's also, that story is really interesting, what you were saying about Richmond Hill. It's a great example of how data often can uncover a trend that you've lived through. I was raised in Richmond Hill,
Yeah.
and that satellite family experience is something that I encountered. It feels right based on the experience on the ground. So it's kind of interesting. You know, you don't think about it at the time.
Yeah.
But then in hindsight, you realize, oh yeah, it's all the kids that I was tutoring would probably fit into that category.
Exactly.
So that's actually very interesting. The other issue I think about bubbles is that for the past 20 years, home prices in the Toronto area have steadily increased. So, I mean, and I'm more than steadily.
Yeah.
It's been a rise in home prices. And yet all that time, somebody's been calling a bubble. So there's a risk of us starting to treat the bubble alarms as like, you know, that too fussy smoke detector that you're always turning off every time you cook.
Yeah.
So my question is, how can we avoid doing that? How can we avoid ignoring warnings?
Yeah.
Are there questions we can ask ourselves when we hear a warning instead, so that we're not discounting the alarm, but we're asking ourselves some questions that would, you know, tell us whether or how seriously to take this information?
That's a great question. A very hard one, actually. Okay, so I'll speak from my perspective as a buyer, okay? I generally don't worry too much about trying to time the market. And it's interesting because a lot of the interviews I've been doing with, I mean, most personal finance people, most economists, it's kind of the same story. I mean, if you're buying a home for 10 plus years, you shouldn't worry about it, okay? That's my general rule. Now, that's not to say that you should just walk around with blinders on and not pay attention to the market, okay? I tend to get most anxious about the market when home prices are going up 20+% a year. And again, that just makes me more anxious. I think for some people, they get excited because they think about how much money they're going to make. I'm always like worried about losing money. So that's I tend to get anxious. And I start paying way more attention to what's going on in the data and the numbers. And, you know, one important consideration is, you know, if we go back to 2017, you know, one thing that a lot of people missed is that when a lot of the people that were calling my office after just trying to get my feedback, who bought homes in March and tried to sell their current home, the mistake a lot of people made was when they went to go sell their current home and they got that first offer in early May that was 5% less than what they wanted, they said no. And they said no because they were greedy, or not because they were greedy, because their neighbor's home sold for 5% more. They want what their neighbor got, but they ignored the data. And if you had been following the data, the market was collapsing from March, okay? From March, listings were surging. And then by April, demand was plummeting, which meant every week that passed, the market, this kind of goes back to sort of the idea of months of inventory momentum, was getting worse, okay? So a lot of those people who had failed transactions, some of them that actually had offers, just made the mistake of not paying attention to what's going on in the market, right? So I don't think, but this again is kind of a decision you make after the fact and assessing what's going on. I personally would have been anxious buying when there are 50 people bidding on homes and prices are going up 30% a year. Like that's probably the types of periods where I would just say, I'm just gonna wait, you know, because it just makes me feel anxious. And those are like rare cases. And that's not, you know, that doesn't happen very often. When home prices are going up 5 or 10%, you hear about 20 people bidding wars in Toronto. That's really normal. That's just a function of people underpricing their homes, which is different from a bubble, right? If that makes sense. I hope I answered the question.
Yeah, so I'm starting to see a little bit of a game plan you might use as an average consumer. If you see these high appreciation rates, you might ask yourself what's going on. Read about what kinds of activity is fueling that. You might be more concerned if you're an active buyer or seller.
Yeah.
At that time, if you're a homeowner, you may be worry a little bit less, realizing that these things probably will come up and down.
Yeah. But here's the challenge with that.
Yes.
Okay. And I remember this. I remember hearing this in offices during sort of the peak of the market when prices are going up, 30% a year. And I remember one agent talking to their buyers when they were, I think I overheard part of the conversation about prices going up. And her argument about why they should just go in with all of their money was because with prices going up 30% a year, the $1 million home that they were buying today is going to be worth 1.15 in 6 months anyways. So who cares, right?
And their agent was telling them this.
Yeah, their agent was saying this. So part of it is who cares. Part of it is if you don't buy now, this same house is going to be worth 15% more. So it kind of goes two ways. One is this is why you should overspend, because it's just going to be worth more in 6 months. The other is if you don't buy now, you're not actually going to be able to afford this house in 6 months because your max budget's $1 million. You can't afford 1.15. So there is this tension when you're a buyer and you want to buy a home to just go into it and go with the crowd. And I appreciate that. I mean, I still probably wouldn't do it because, again, I have a very highly risk-averse mindset.
So that takes us nicely to my next question.
Yes.
One of my last. The theme of our summit this year is smart caution.
Mm-hmm.
What does that mean to you?
Smart caution for me is really understanding some of the downside risks when you're jumping into the market. I think in the GTA has this mindset like you can't lose with real estate. Like a lot of people make decisions without considering all of the facts, whether they're buying pre-construction condos or investment properties, whatever. And I think it's important to slow down and understand sort of the worst case scenarios so that you can at least try to mitigate them. And I think people don't worry about that. Like one of the classic examples is a lot of people who were buying homes in the spring, bought just before COVID, and all of a sudden when they went to go sell their home, the market fell out from under them and there were no buyers. So what do you do? And what do you do when you can't get the price that you want? And again, I think when you're not thinking about the worst case scenario, you don't have a great plan to mitigate these potential risks. So I think that's kind of the one thing I would say.
And our final question, which we're asking all of our guests,
Mm-hmm.
Would you buy or sell a home right now?
Yeah, so like I said earlier, I don't, when I'm buying a home for the long term, I don't try to time the market one bit. And, I remember looking at a house in 2017 at the peak of the market, making an offer, and most people I knew thought I was crazy because I was kind of writing about how the market was insane. And even I actually contradicts even what I just said earlier, that I would not be buying in a market where prices are going 30% a year. So this is a good example of even sometimes what we think we say contradicts sort of our own actions. But I offered on that place because it was a unique property, right? And, I was looking for something specific for quite a while in this neighborhood, and this property just happened to come up. And my mindset was, I don't care if it falls 20% in the next year. I'm like owning it for 15 years. So what happens in the short term doesn't really matter, because for me, the harder thing is finding this type of property with this lot, in this area. The short term makes no difference to me. I don't sweat it. And in the end, I didn't get it. I would think it was the second highest offer, but I wouldn't have regretted it even if I did, and I probably still would have been fine today, and wouldn't have cared if prices fell. So that's generally kind of how I approach things, and I think that's how most people should. They should be looking to the long term and not, even if you buy and prices fall. This is the thing that I think is important. A lot of people have everyone on the outside telling them you're crazy, you shouldn't be buying. The way I had people telling me. The reality is no one can predict it, and you can't sweat it if prices happen to fall 10% after you buy, because no one can predict it, right? It's like worrying about, your stocks portfolio from one day to the next. The point again is, what does it look like in 15 years when you're selling? So I think that's the key thing.
Great. Lots of great takeaways there. Thank you.
Thanks so much.